Soft start to the month with the markets down over 1%, NASDAQ down over 2%. But nothing in the last few days is, from a headline perspective, has really shifted the narrative. So we're kind of in this volatile period as we get through a bunch of financial reports and whether it's jobs out this week or inflation reports and the Fed cut and other central banks cutting. But there is still a bullish narrative, which really revolves around the soft landing discussion, which ebbs and flows, but it looks like it's picking up traction again. The 150 to 200 basis points of anticipated Fed rate cuts, certainly part of the bullish narrative. Earnings have been pretty strong. We're up about 10% year to date, looking for an 11% year this year, maybe 15% next year on the S&P, which is pretty healthy. You have an estimated 1 trillion in buybacks in the US, and then you still have the secular growth theme for AI pushing things along. On the bearish side, you have the negative sentiment around seasonality, with September not being a great month. Is the market way ahead of themselves on Fed easing expectations? And I am on the first slide, Mark.
Okay.
There's concerns about cracks in whether the consumer resilience in their spending can continue. We have the elections. We have fiscal excesses and stretch valuations. So a lot of positives and negatives on both sides of the ledger, but we still continue to view the US as the best opportunity for equities from a risk-reward perspective. But we acknowledge that there's some other attractive opportunities given the valuation differentials between the US and the rest of the world, as well as the changes in terms of trade have created some new growth prospects for nations that exist. Longer term, we're still worried about the outlook given debt and deficit levels, both in the US and elsewhere, and the populist proposals that are going out all around the world from politicians are not exactly, in my view, what we need to be successful. So a lot going on. Today, I want to touch on 3 topics: the East German elections and what that might mean. We've talked in the last couple of months since Biden stepped down and VP Harris stepped in as who's going to define her. Trump has been exceptional in the past at defining candidates in a negative way. But so far, Harris has done a pretty good job. We want to talk about that and what that means for the election and where we're seeing some opportunities. So we'll jump right in. So half the world's population is voting this year. You can see in the light blue is the elections that have already been held. The dark blue is elections that are coming. And this has been a tough time for incumbents. Just ask Macron, ask Schultz, ask Biden, ask others. It's not been a great run for the incumbents. And I think that's not going to change anytime soon because people are frustrated. And you're seeing that, and you saw that in France earlier this year, where the far right originally won, and then the far left did better in the second round, and now we're still without a government there to speak of. And now in Germany, you had these elections in the East, and the AfD, which is the far right party, did quite well this go around, but the left did pretty well also. And really more importantly is the BSW, and if we have Germans on the phone, they can pronounce the woman's name who's leading that. But in 8 months, they've gone this far in terms of getting share in this one region, and they did quite well in 2 of the regions, and that puts them in a spot where I think they have more power than the incumbents do, and the old legacy parties are kind of lost their way in this new wave, and I think that speaks to the frustrations of populations. These are the issues that the voters were highlighting in one of the regions, and obviously crime and violence, that is often linked to immigration and asylum seekers. So I think you have to look at them somewhat hand in hand. The war in Ukraine and what that means for peace, particularly if in the East, matters. But I think the other issues are inflation. And I think one of the biggest issues is their trust in governments to help solve the problems. When you have immigration problems, cost of living problems, and economic problems, climate transition problems, and others all occurring at the same time, how many of these governments that are kind of piecemealed together can affect policy changes that would drive the economies forward? And I think the populations are really getting frustrated by that. And it's why you have a startup like BSW do as well as they did in a short period of time. Whether it's sustainable or not is to be determined, but I think this is a sign of, not just in Germany, but elsewhere around the world, the frustrations that voters are having and why it's tough to be an incumbent right now. I think the German elections in the East may be the most impactful this year, other than the US, in that Germany is such a big part of the European initiative. I think the rise of AfD has its own initiatives and that their leader might be viewed as an extremist. And from a national security perspective, if they're viewed as an official extremist organization, would you turn over national security issues to them? These are issues that are coming up with a lot of the politics that are existing around the world today, is how extreme are extremists and how far right and far left are the far right and far left. I mentioned the BSW becoming a force in a very short period of time. I think the big issue that we're seeing right now is a frustration with governments, with people's lives and livelihoods, and the economic weakness in autos and manufacturing in Germany are a big issue, as evidenced by the Volkswagen news today, where they're considering for the first time closing down plants in Germany. One reason for it is they can't be profitable just through attrition of their workers, and they agreed to keep their workers in place for a long time, and that has actually created some lack of competitiveness. But you also have energy problems, you have public policy issues, you have China dumping autos, you have the US with our industrial policy, and Europe being somewhat devoid of a real industrial policy that's going to move the whole region forward. But when you take one of the best economies and take out two of their best sectors and put them in the penalty box after a third sector for them, which was finance, particularly banking, took a hit in the financial crisis, it puts them on what's going to be the driver for moving them forward going ahead. And I just don't see it right now. I think they're also paying for past sins of the over-reliance on Russian energy and China exports, but they're also relying on imports from other countries in Europe to drive them forward. And I think that's a tough model too. And I think the biggest issue is the fiscal discipline that has been a part of the German culture since the big inflation of the Weimar Republic, that I think you're really in a state where they're being too fiscally conservative when they needed to be spending more to be competitive. And now to spend it when we're off of the zero interest rates and starting to move up to higher interest rates doesn't seem like the right time to do that either. So tough times in Europe ahead, and I don't see that getting easier anytime soon. And I think the one area of Europe that's done particularly well is the southern part, which is benefiting from a lot of tourism. May see, if the US cuts rates and the dollar weakens, may see that tourism opportunity start to decline. And what does that mean for the growth prospects of Europe overall? I think it's going to be a tough go over there. Shifting gears to the US, we've talked about who defines the VP. Is it former President Trump, who has been exceptional in the past at defining his competitors in ways that is not positive, and they've struggled with that, where I think Harris has done a remarkable job of positioning herself without positioning herself. I think we're all waiting for her to take a stand on a lot of things with specifics. She's given broad strokes, but it's worked quite well for her. As the change in her favorability ratings in a very short period of time is unlike anything I think we've seen in the Real Clear Politics polling history. This is one of the fastest turnarounds for somebody, and yet the voters are still waiting to know what the real policies are going to be to back it up, particularly since she is evolving her policies and her previous stances in a number of areas. But not dissimilar to Europe, higher prices are a reason for personal finances getting worse is one of the big hurdles for her. And I think that will be an issue for whether it was her or Biden would be an issue. And the other one is the border situation. And most of the U.S. thinks that both parties have done poorly in handling the border situation. I think they're right there. I think our immigration policies have been awful for a long time. I think what you're seeing now is a mishandling for years and decades of our immigration policy here. But you are seeing immigration policies change in other areas that have been much more liberal, and Canada is one where they're having putting border restrictions on as well. So I think the cross-border challenges are going to get much greater for migration issues, and that's going to create its own set of problems for leaders. So I think, to her credit, Vice President Harris has done an exceptional job of gathering support from the Democrats and pulling the Democratic Party together. But I think the next month and a half or 69 days, whatever it is to the election, are going to be a challenge. And in 1 week, we're going to have a debate with former President Trump. And I think that'll be a very important debate for Harris to withstand Trump's attacks and not lose her cool and be able to explain her policies. And in fairness, I don't think Trump's been very specific about any of his policies either, other than broad strokes of mass deportation and things like that, and big tariffs, which might not get through. And in both cases, I think a lot of people are hoping for a divided government so that the extreme policies of each don't get put through. But it is going to go down to the finish line. I think Harris has done an exceptional job of helping define her candidacy without taking any stands. And I think the longer she can do that, the better she will be positioned for moving forward. So I want to switch gears to where to find opportunities. And you can see clearly from this chart, since the great financial crisis, it's been a tough run for emerging market equities, but a pretty healthy one for U.S. stocks. And the view is that reversion to mean is due to take hold, although that's been said for most of the last 5 years at least. But I think there is a real opportunity with our cutting rates and a weakening dollar to take some pressures off the emerging market economies and see some return to better economic outcomes there. But the hope that the U.S. is going to slow down was kind of thrown for a loop last week when Q2 GDP was revised up to 3%, which is not exactly recessionary categories here. As you can see, going back for some time, this has been pretty healthy. At the same time, personal consumption expenditures were up, so we were continuing to spend in the face of what looked like a weakening consumer, but the consumer feels stronger than it has been. So I think the U.S. is going to do quite well, and I think the Atlanta Fed's GDP now is just raised up again for Q3 and Q4. So be interesting to see how that plays out, whether we get the reversion to mean as fast as people think. But I do see opportunities from the emerging markets for a couple of reasons. One is they are getting back to their higher average GDP growth per capita than they have in the past. And I think this is one of the things that you can see from the chart. Really, when China started to slow down and we started to move to zero interest rates and commodity prices came down, I think that a lot of the bloom came off the rose in the growth rates of these economies. And then some of the debt burdens started to kick in those areas as well. So when you're having tightening and a stronger dollar, it really weighed against some of these economies. And now that we're starting to shift policy or expected to shift policy in the US, that should make things a little bit better. And the other thing is corporate earnings. Well, in the US, they remain strong. They are stronger in the emerging markets. But I would really point out on this chart, look at the struggles of earnings growth for a change year over year in Japan and Europe, where the US is growing at a very healthy 11% rate in line with where the globe is. But you can get a sense of what China's doing in terms of its weighing on the emerging markets from the two top lines, which is the top one is emerging market corporate earnings growth without China, and then the next one is with China. So strong growth and a broadening out of opportunities around the world, but I think there's a need for real selectivity. because of politics, because of debt, because of other issues, and because of really the alliances that have been formed around the world of where you're sourcing your critical resources from. What is that going to mean for you? So I think earnings have been healthy there. I think you need to be really selective. I wonder, though, do you get the benefits of 9% higher growth or 8% higher growth? Is it worth the risks of a less mature capital market system, less reliability of rule of law, and other things? So I think there's some issues there. I think there are positives coming out of the emerging markets. I think it comes down to selection and sizing for where you want to look at it. So I'm going to wrap up quickly, Mark. I think the world is thinking about the changes going on differently than we are. We think we're going through a normalization of rates, of the economies, and getting past the disruptions, whether it be the pandemic, whether it be the wars, or whether it be other issues we face in recent times. I think we're getting back to letting the economy stand on their own a little bit better, and I think that's going to mean less activity from central banks and less activity from the governments than we've seen over the last 10 years, which has been exceptional. And if you go back, we've talked about over 30% of GDP, world GDP went to solve what was basically a 6% decline in GDP. So you were putting $33 trillion to work to solve a $6 trillion problem. And I think that's really what we're getting back to, is not having that kind of excessive support. And this means we're getting moved back to more normal interest rates. And you're starting to see that in the US yield curve. So I think that's part of it. I think the second part is that that a lot of the problems in Germany, China, Japan are benefiting the US and a couple other economies. We're not exclusive. Southeast Asia is doing quite well, but you have to worry about two of their best economies there. South Korea and Taiwan are really beholden to what happens with China right now. But I think what's gone on in Cambodia and Vietnam and other countries can continue to benefit from the growth of changing supply chains. Best opportunities, regardless of where you're investing, for us remain in defense, energy, infrastructure, healthcare, and productivity. I think, as Nicholas was saying earlier, that the tech boom is going to be with us to stay, and it's going to lead to improvements in other areas, particularly with healthcare outcomes. And if we do have another wave of a pandemic, whether it's Mpox or you're starting to see dengue and polio and other things coming back, the ability to solve problems with healthcare at a much faster rate due to technology is going to be a big beneficiary. I think as we're wrapping up, I think the world is doing better. I think other than the US, the world's leading economies are not, other than India. And I think that means that the US will continue to suck capital from around the rest of the world. And I think it's going to continue to surprise investors to the upside. I am not naive about the policies of both candidates right now and the impact on that longer term. But in the near term, I think the benefits of what's going on in the US for energy independence, from the Inflation Reduction Act, the CHIPS Act, and the National Defense Authorization Act, are things that, other than China, most nations are not doing aggressively enough. And I don't know that they have the wherewithal to do it at this time, or the political will to get it done. So I think we have debt and deficit problems in the US that we can't ignore forever. But in the near term, I think we continue to benefit versus most of the rest of the developed world, and even most of the rest of the world. So Mark, I'm going to stop there and open it up for discussion.
Thank you again, Stephen. 230 weeks in a row. Thank you. Questions, comments?
I want to hear Terry and the other guys speak about travel tech.
Yeah, Terry will talk soon about hospitality tech and that landscape, and a couple companies doing innovative things. Adam.
Good morning, everyone. Thank you, Stephen. Excellent presentation. Love it.
Thank you.
Question for you.
By the way, Adam will be among the deep dive providers next week. We're going to talk about geopolitics and dual use tech.
And I'll be focusing on Russia, the Russian economy and the geopolitics there.
Correct.
The emerging markets GDP growth, excluding China, but regardless, excluding China or including China, both, where is that growth coming from? Is that domestic or is it international? That's my first question. The second question is about, you mentioned less developed capital markets in these emerging markets and investing in those. What risk factor would you place on that particular variable being less developed capital markets? I hope that's
I think the countries, to answer your first part, I think the countries that are winning are really, it's the shifting of share from the change in supply chains, mainly the shifting away from China to other areas. And nearshoring and friendshoring are what's driving those changes. So Mexico, Vietnam, Laos, Cambodia, who are providing low-cost labor as a substitution for what China was providing, I think is a big part of that. I think those are the primary drivers more so than domestic economies. It's really a shifting. And I think for all the discussion of deglobalization, I don't think the globalization has changed. I think it's just shifted sourcing. So that's the first part. The second part of your question was, I'm sorry, I wrote the answer for the first, the question for the first one, not the second.
Quantifying the risk factor of the
the risk of lack of the immature capital markets.
Yeah.
So
quantifying that.
Just for a little perspective, Apple and Microsoft would be the leading market cap in Europe. It would be bigger market cap than the indices in Europe alone.
Yeah.
So that just speaks to the differentials between the two. We're making that situation worse is for Europe in particular, but for other places, is you're starting to see delistings from those areas to the US, for example. A leading aggregates company out of the UK moved to the US with a 12 multiple when their competitors were in the 20s. Same business, different domicile. That shift alone will give them an uplift in their gains. But I think it really comes down to the fixed income side as well. That's the engine for the liquidity that drives capital formation, and the U.S. dwarfs the rest of the world in that area from a country by country basis. And I'll try and bring a slide in of the respective market caps of the U.S. versus the rest of the world in equity and fixed income. And if you see it charted, it's unbelievable how much bigger it is. And I think it's one of the Achilles heels of a country like India, because they also come with capital controls and other issues too. So it's not just the depth, but when you have capital controls, that actually changes what your risk reward profile is. Their adherence to the rule of law changes that as well. I think those are a couple of the other factors that go into it. And then what's the backing behind those markets? And you saw when we've had two crises, including one with the Silicon Valley Bank one, which should have been a real issue globally, we were able to step in and solve it right away. So I think the other issue that goes with that is the strength of our financial institutions coming out of the financial crisis has us way ahead of Europe, for example, way ahead of Europe, because we recapitalized the banks. They really didn't. And they didn't really solve the problem. They just shifted the problem pockets on that problem. So I think there's a number of issues, but really when it comes down to it, it's not a problem until it's a problem. And that's usually in times of crisis. So it's not a problem getting in, it's a problem getting out, and getting out at what price. So I think those are real issues for investors. And I think when you think about investing, and if you go back to what I said at the beginning, I think the US is the most attractive on a risk reward perspective, not necessarily that we'll have the highest returns, but I think when you look at the whole package, I think that kind of puts it in context. And I don't have the number for the global equity market cap, but 70 trillion somehow rings a bell for me. Bill, I don't know if you have that number handy, or Andrew, if he's on, Andrew Fish might have it, but I think the US is probably 40% of that. So for perspective, we dominate the markets. So I think that really matters when times get tough.
Certainly does. Thank you.
Any other questions?
I would just add, Mark, for Adam's talk on Russia next week, I think there's a really fascinating dynamic that Russia, their finance minister did an exceptional job the last year or two, but I think the problem is going to come home to roost now for Russia, and you're starting to see it there as well. I think they're going to have some real challenges themselves. Their industrial base is getting hurt by their inability to bring materials in and other things. So I think the sanctions don't work very well, but they are starting over time. They do degrade what their ability to produce is, and I think you're going to start to see that over the next year.
Fair. Well, we can talk about that next week. Andrew, last question.
Yeah, no, Stephen, I was just gonna completely anecdotally confirm your point about you mentioned Mexico being a beneficiary. I spent 2 weeks in South America in August, and I visited ports, free trade zones, and everything's growing. They struggle with a bit of inflation and currency volatility, but everything's growing. And when I went and looked at the numbers, they're actually productivity is growing. GDP per capita is growing. So it's not even just more stuff. It's business is being done better. And again, anecdotal observation, they're importing Western technology and not in huge, a bit at a time. So this huge opportunity for productivity gains in places that were just labor. So I